out that she got 8 out of 8 of the multiple choice correct. That's all you'll find out, because obviously you can't grade the essays. That's me. I believe there is retake possibility if you wish. I personally would only want to take it once. You know, as we talked about it in this class last week. In her class, I didn't really talk about it until Tuesday, and she had taken the exam without. So, especially impressing me on the uniform capitalization. Remember, we talked about that, the answers to warehousing.
That one was a doozy.
Yeah, she found it though somehow by reading about 10 pages.
Well, once you read, like, you know, because the book lists it, but it doesn't give you that exact word.
One, yeah.
So you have to go through the examples of the book
and rule out the others.
And then rule out. That's what I did. It was very entertaining.
Yeah, I'm sure. So if you basically can get that, I always put a deadline of 10 o'clock, as you know, so I can start actually grading those, and maybe I can even enter the grades on Monday, because I'll be working Monday, even though it's a holiday officially. But, you know, go to fireworks or picnics with the family and so forth. Any questions administratively here? The term is going so quickly. If anybody wants to keep a surprise, no, I don't. What time does the hockey game start? Okay. I had a person in the Tuesday class. She doesn't say much, but occasionally she keeps it up on her screen and she's taking notes and stuff. But if you want to share with us, great thoughts. Okay, first I want to talk about active, passive, and portfolio income, and comment on this area. And I have a beautiful handout here that we're going to spend some time on. When I first started working in taxes, there were a lot of tax shelters that often presented themselves that if you invest in our shelter, we'll guarantee you a significant number of loss write-offs. Now, because a lot of these were basically kind of, I think, abusive, there's been a number of times where legislation was passed by Congress to restrict these. And the most recent ones are under Code Section 469. So first of all, let's identify typical items that go into active income and then passive and the category portfolio. Then I want to go through the handout from the U of I Tax School. First of all, what would be included in active income, everyone? Active income.
Your salary?
Yes. Salaries and wages. Commissions. But on their final exam, which is online, they have an item I wouldn't have thought of. So in addition to salaries and wages and commissions, put down a working, that's the key word, a working interest in oil and gas property. A working interest in oil and gas property. Let's stop a second. Bill, I thought that people who invest in oil and gas partnerships are basically just that, they're investors. I used to, when I was at Anderson, I had people who had investments in limited partnerships like Apache Oil, the Masabi Trust. And we were always waiting for those K1 schedules to come in so we could complete their returns. Well, for those people, that would be passive income. This says for one of the multiple choices on a version of the final, a working interest. You know what that means to me? You're out there at the drilling rig, you know, with a hard hat on, getting covered in crude oil, you know, or petroleum, liquid gold or whatever. So, so the key word there is working interest. If we just said investment in oil and gas partnership, that would be passive income. So let's put down passive income, limited partnership interest, such as in oil and gas, limited partnership interest, having rental condos, but there are some exceptions we'll talk about in a few minutes with this new handout. And also under passive income, owning a business, but not materially but not materially, I have trouble pronouncing that for some reason, participating. In other words, you don't have material participation. Bill, what is that? We'll talk about that in a few minutes. So owning a business and not materially involved in the business, having a limited partnership interest where you're strictly an investor, having rental condos. What are examples of portfolio income?
Stocks.
Yes, sale of stocks and bonds, dividends, interest.
Annuities.
Keep going.
Annuities.
Annuities, yes. Annuity income, excellent answer, Margaret, excellent. Interest, dividends, annuity income, sale of stocks and bonds. I have one more I want to talk about. Well, the one I have in mind is this. Royalties not derived from the ordinary course of a trade or business. Royalties not derived from the ordinary course of a trade or business. Remember Michael Jackson? Well, we know he's deceased now, of course, under a very suspicious circumstances. But Michael had purchased the copyright to all of the Beatles tunes. So if someone wanted to use one of the Beatles tunes, let's say they wanted Hey Jude or something, they would have to pay royalties to Michael. That would be portfolio income. But Michael also wrote some songs himself that he recorded. Royalties for those would be active income because he was the one who created the particular subject matter. I had a student once who works for the company that handles royalties for the estate of a famous singer, Jackie Wilson. So anytime somebody plays higher and higher, they have to pay royalties to this company who then disseminates it to the, well, basically the beneficiaries of the Jackie Wilson estate. And for those beneficiaries, of course, it would be portfolio income. Now, when you become a CPA, we're not saying if, we're saying what? When? All right. You'll get to do continuing education courses like Bill does. I have to go for my law license as well as my CPA license. And they're conducted by a variety of organizations. But the University of Illinois Tax School is one of the best sources. They used to have a 3-day program, and I noticed this year they only have a 2-day program. And for 2 days, it's like $320, which is cheap because that's normally a 1-day program through the Illinois CPA Society. And it will give you 16 continuing education hours for CPAs, only 13 for attorneys. And you don't go to Champaign. It's at numerous locations throughout the entire state. I go to the one that's in Lisle.
Oh, you're okay.
It usually sells out quickly. It's at the, well, it was a Wyndham, now it's the Sheraton at Naperville Road and Warrenville Road. Next to that, Mullins Bar and Grill. So excellent there. There's 3 speakers. There was a gentleman who used to work for the IRS who died recently. So we got a young lady there who used to be part of the central team. I think she talks a little bit quicker than I would like. But there's the great speakers. I highly recommend it. You'll see me there. And this is from the workbook that I printed this out. Dealing with this subject matter, so I'll kind of give you a chance to look it over. And we'll look at selected pages, but you might want to read the whole thing, not just for success. This is on the final exam in an essay, so it's a little bit broader, but for your own knowledge. Because normally, passive losses are only deductible to the extent of passive income. Passive losses are normally deductible only to the extent of passive income. And the losses that you cannot deduct become what they call suspended. But there are exceptions. if you materially participate in the activity, instead of the income being passive, it could be deemed to be active. And if it's active, guess what? You can deduct additional losses. Now, I'll let you read this on your own, but I do want to look at selected pages. By the way, on page B133, at the top, notice for material participation, it says, this is at the very top, this will be on the third page, like, the conduct of the taxpayer in connection with the activity must be regular, continuous, and substantial. Now, go to the next page. There are a whole bunch of tests. I believe there's 7 different tests. You have to meet only one of them. This is on page B134. You only have to meet one of these tests to be a material participant, in which case your income is not passive, your income would be active. Look at, and go through this, you won't need all this depth for the exam, but please look this over. It's pretty well written. Most taxpayers who qualify under this provision qualify under test 1. Test 1 says devoting more than 500 hours to the activity. That would be throughout the year. Would that be a really burden? I don't think so. 500 hours throughout the entire year? Remember, it's got to be regular, continuous, and substantial. And you can look at the other tests. I had some clients that where one or so of the other tests apply, but that's the most frequent test. So you only have to meet one of the tests, and then you could treat this as active rather than passive income, and you would be able to deduct additional losses. But there are some special exceptions for real estate. So let's look at that briefly. On page B141, B141 says real estate professionals. There's 2 areas here. First one is real estate professionals. Notice it says here, rental real estate activities for these taxpayers are not automatically classified as passive if they materially participate in the rental activities. Then they can treat the losses as active instead of passive. Now, for a real estate professional, it says you must meet all of the following qualifications. You own at least one interest in rental real estate. More than half of the personal services you perform in the trade or business during the year are performed in real property trade or businesses in which you materially participate. That basically means your primary activity has got to be real estate. Taxpayer performs more than 750 hours of service during the year in real property trade or businesses in which they materially participate. This is a difficult standard to meet because basically your primary activity has got to be real estate. But we have a student in Deja's class, Jackie Yannick, remember, sitting in the back? She owns some real rental properties. But obviously she's not a real estate professional, she could never meet these standards. But there are some benefits for her and for somebody who just has like a condo. Len Grinstead here at the center was renting an apartment in Naperville here, but he owned a condo on the near north side of Chicago that he was renting out. Now it turns out he's living there, but when he rented it out, he might be able to qualify. So let's take a look at that requirement, and that's on the next page, B142. Special $25,000 allowance. Special $25,000 allowance. Individual taxpayer, etc., may be able to deduct up to $25,000 of passive rental real estate losses against active income if certain requirements are met. Now, This means it's not active income, but you can deduct passive losses of up to $25,000 in excess of passive income. But there's a phase out, we'll see in a second. In order to qualify, the taxpayer must be an active, not material, an active participant in one or more real estate rental activities. Active participation does not require as high a level of involvement in the activity as material participation. Sure, but it also is a lesser benefit. The active participation requirement does not require the regular, continuous, and substantial involvement that we looked at earlier. Active participation does require the taxpayer to participate in management activities or arrange for others to provide necessary services such as repairs. Now look at these three examples, because I asked the student on Tuesday. I said, do you do these three items? I said, do you approve new tenants? And she said, I have a real estate management company, but I approve, yes, I have to approve new tenants. Do you decide on the rental terms? And she said, yes, I set the rent that's for each apartment and the term of the lease. I said, do you approve any repair or capital expenditures? She said, yes, I do. The rental company will tell me if like they need a plumbing repair, but I have to approve it unless it's a negligible amount. So I said, you've met these three requirements, so you are actively participating, and therefore you could receive up to $25,000 of passive losses in excess of passive income. Now, there is a phase out. In her case, because she's a student now and has work experience, she may not have a problem with this, but later on she would. Because there's a phase out of the $25,000. Let's go to page B145. B145. Don't you love taxes, all these different rules? If you can stomach this material and understand it, usually there is significant job opportunities. I know we have Senator Sanders from Vermont who's going to eliminate the income tax and all this stuff, but that's never going to happen. So the job security should be there. The $25,000, this is B145, special allowance is also subject to an income phase-out rule that may negatively affect higher income taxpayers. The $25,000 allowance is reduced by 1/2 of the amount by which your AGI exceeds $100,000. So that would mean at an AGI of $150,000, you would not be able to get this $25,000 allowance because you lose 50 cents on a dollar. Now, a lot of you, if you're not there now, I'm not certainly, may be at $100,000. In which case the phase out will start applying. With my income here from the school, if I had rental property right now, I would be able to, because I would meet those three requirements, trust me. I want to prove these things, and I would be able to take the $25,000 passive loss if I had that much passive losses in excess of passive income. So that could be things like depreciation on the property. So I would not be impacted, but notice this does impact upper middle income and wealthier people. So for the final exam, which is their final, there's some really easy essay questions. I'll even give you those in advance. So, but I want you for your own knowledge to go through this handout. There were some additional pages, but I didn't think they really applied. Now your days are busy now, but maybe during that 1 week break when you're looking for stuff to do, after the course is over, maybe read through this. There's some good examples in here. And if you kind of like it, you might want to attend one of the U of I tax school sessions. Okay. So that's my passive loss area. Now I want to talk about a variety of topics. Notice on this screen over here, this whiteboard, I've got some categories, and I'd like to talk about those next. And we've had some excellent posting in here. Again, and in the other class as well. Oh, by the way, I want to mention one thing though, before the exam next week. One person in here and one person in Deja's class both did some great research, and they found the employee death benefit from that Cornell Law website, but it still talked about the $5,000 exclusion. That was repealed a number of years ago. So for the exam next week, that we'll talk about a little bit later today, for the exam next week, if it talks about an employee death benefit, this is a program the employer has in effect to give money to the beneficiary of a deceased employee. This is not your traditional life insurance. Remember, it's fully taxable to the beneficiary, and fully deductible by the payor. The two students who posted on this found that old code section with the 5,000 exclusion, but unfortunately, if you shepherdized that, you citated that, that was changed. But those people did excellent research, though. We've had some really high quality research in the tax area, and it makes me very happy. So, and I expect that from Keller students. Now, membership dues, we've had some posting in this area. First of all, let's put down membership dues and read some of the posts. Membership dues will have a category not deductible. Then we'll have a category deductible. Then we'll have a category probably deductible. And I was reading some of the posts today, and they cover the same material, but I'll just disseminate to you as well. Not deductible. Dues paid to country clubs, supper clubs, athletic clubs, and hotel and airline clubs. One of the posts that somebody put up there talks about this. Surprisingly, hotel and airline club memberships are not deductible. No, they're not. And it's interesting because for a number of years in the 80s, I used to have to do a lot of traveling for my company. And I was a member of like the Sheraton Club, you know, where I got, at that time, a room with an answering machine and a fax machine, you know. And late checkout and early check-in, and I belonged to the American Airlines Ambassadors Club with a special lounge when your flight was delayed or canceled, because I used to have to go to Tulsa a lot, and they always loved to cancel the flights. Then I went to New Orleans, and there they didn't cancel because there was more patronage. They used to go to Atlanta a lot too. So those membership dues not deductible.
Were country clubs ever deductible?
I don't remember them being deductible, but let's follow up on this. When I worked at CBI Industries on Jury Boulevard, near where the massive demonstration was for McDonald's, we used to belong to the Chicago Tax Club, and the dues were $25, and our firm paid for that. Well, our firm decided to quit paying the $25. But as part of my job, I got to see the officers' expense reports because I had to defend them before the IRS agent. And our company was paying $15,000 a year for each officer to belong to the Butler Country Club. Now, what do you think of this? That's not deductible per se, but that was additional form of compensation for the officers. Now, that means the officers would have to pick that up into taxable income, wouldn't they? So what did we do so the officers didn't have to pay tax on that? What did we do? We don't want the officers to have to pay tax on their $15,000 membership in the Butler Country Club. Well, there's a formula. You gross up their wages to cover the additional tax liability for both the membership dues and for the gross up, because no one's taxed at 100%. So we did that, but it always irritated the hell out of me. You won't pay me $25, but you're paying these five guys $15,000 each for the country club. No, so I think that rule's been the same for quite some time. Now, put down deductible. Professional association dues, less the lobbying portion. Professional association dues less the lobbying portion. This is the time of year when a lot of those dues notices come out. And on one of them, I remember it said, 7% of your dues are not deductible because they represent lobbying expenses for legislation on behalf of the profession. So it means you should be deducting 93% of the professional association dues. Now, probably deductible. And again, look at some of the posting that people have done. There's some excellent posting in this area. Fraternal organizations, dues to fraternal organizations that also serve a charitable function. These are probably deductible. And one person's posting talked about, is the major goal of the organization entertainment, or is it other purposes? Now, let me just comment a little bit about my own perspective. This was put in the law in '86. I believe the intention of Congress was not to allow membership dues to be deductible for places like the Elks, or the Lions, or the Shriners. But they argued, and members of Congress in 1986 were members of that generation. Your generation doesn't join these groups that much. My generation even doesn't. My dad was a member of the Moose. And that was because the Moose maintained that orphanage out west here, Mooseheart, which originally was only open to Moose members where both the parents died and therefore the child needed to be raised. So that's when my dad joined the Moose. And it's, by the way, it's an excellent place. And they accept non-Moose members, and it's not, don't have to be an orphan now. They can be from a disjointed family, but they do a really nice job. Now, my dad, they built a huge facility in Bensonville. It was like a miniature factory where they had a lot of social events, dances and fish fries, and the bar where the World War II vets talked about, their experiences. But the Moose membership went, and my dad used to say, take my card and and go. I just didn't have any interest in going. Now, there's a few, they closed that and sold that facility, and like there's one Moose Lodge, it's on Roosevelt Road in Lombard. It's about the size of this classroom. It's in a little strip mall. I've never been in there, but I assume they have a few booths, a bar, and probably a pool table, and that's it. People aren't joining. But a lot of these organizations do a charitable function, like Mooseheart, or the Lions Club, the blind. What about the Shriners? What's their field? The Shriners. Okay, crippled kids. The Masons, Knights of Columbus, B'nai B'rith. So these organizations basically do often have a lot of charitable function. There may be some social outlets, but I would say dues to those organizations, and read one of the posts that somebody put in there, talks about that and does agree that those would be included. Ever seen the Shriners at a parade? Because they have the fez hats there and the little motorcycles. I don't belong to any of those groups, but whatever. Lobbying. We just said lobbying basically is what? Excluded. Well, yeah. So put down lobbying expenses meant to influence legislation. Lobbying expenses meant to influence legislation is not deductible, especially at the federal or state level. Especially at the federal or state level. What is the purpose of most lobbying? What is the purpose?
To get like a bill changed or.
That's right. It's meant to influence legislation. Margaret's right. It's meant to influence legislation. However, one more sentence that actually applied to my old company. Lobbying expenditures are deductible. Lobbying expenditures are deductible if they're only meant to monitor legislation. Lobbying expenditures are deductible if they're only meant to monitor legislation. We actually had that situation. Go back to the 1980s. Remember, Al Gore had not invented the internet yet. The company I worked for at the time hired a lobbyist in Washington, not to influence legislators, but he would call me 3 times a week, just to tell me what the status was of the legislation. Today I could check that myself off the Federal Register or so, where it talks about all the different meetings and everything. So because we had a client who was very interested in a proposed bill, and we wanted to keep up to date on what was happening, what was the status of that particular bill. But most lobbying would not be deductible. Okay, business gifts. What is the amount of a business gift that you could give to a customer per year and deduct the entire amount? Anyone remember the dollar amount? $25. Guess what it was in 1973? $25.
Why would it increase like over all these years?
Well, you'd think that they might at least adjust it occasionally. It doesn't have to be indexed to inflation, but
I mean,
yeah.
it's usually $5.
And remember how big inflation was like in the 80s. Now let me see, now on the exam, let's say I'm going to give out 4 gifts. These 3 young ladies and this gentleman. I'm going to give this gentleman a $10 gift. I'm going to give the ladies $30 gifts. Well, they appeal more to me. We should be thankful. So let me see, 30, 30, 30, and 10. I gave 4 gifts times 25. I can deduct $100. Is that right?
It'll be $85.
That's right. Because remember, for the young ladies' gifts, I could only deduct $25 each. For the gentleman, I only gave him $10. I can deduct 10. Now that's going to happen on the exam. That'll be the last of the computational multiple choice. I'm going to give something like 4 gifts at $10. How much could I deduct for that? 40. 4 gifts at $25 each. Everyone? 100. 4 gifts at $50 each. How much can I deduct? 100. 4 gifts at $100 each. 100. There you go. There you go. There's no carryover if you're cheap with somebody. All right.
Well, they be getting a cheap by cheap gift.
That's it. But it is interesting how it hasn't changed. There are some exceptions, and I put that in the shell if anyone's interested in that. Expenses associated with tax-exempt income. Let's talk about this. Now, for the exam, this will be obvious. In real life, there's shades of gray. And I don't mean that movie, I'm sorry, because I shouldn't use that phrase. I didn't see it. I understand that it was very popular, especially with ladies. Some of you, I think, saw it.
I did.
Okay. But at any rate, let's indicate something here. First of all, let's do some common sense reasoning. If you purchase tax-exempt securities, are those subject to federal income tax? It's like state and municipal bonds. No, like what do they call them? Tax what? Exempt securities. So what if I took out a loan from a bank and I used the proceeds of the loan to buy state municipal bonds? The income on the bonds is not taxable, so should the interest on the loan be deductible? No. No. So let's write that down, but then let's talk about the more typical situations. Tracy, you're just in time for the dictation. Then I'm going to talk about the only other thing was the business gives $25 per donee per year. And if I gave a $10 gift to someone, that's only $10. If I give $100 to gift to someone, I could deduct $25. I don't want anyone penalized because we don't have official breaks here. Okay, here we go. Interest on a loan. Interest on a loan is not deductible. Interest on a loan is not deductible if the proceeds of that loan, are used to purchase, if the proceeds of that loan are used to purchase tax-exempt securities. Sorry, I had to have a swallow there. Now, that'll be great for the exam, but what's more typical in real life? Let me talk about this. Let's say my company has a portfolio of tax-exempt securities. The holiday season is approaching around December. So I take out a working capital loan to replenish my inventory for the big selling season. And I deduct the interest on that loan. I think the IRS might challenge that deduction because they might say you should have budgeted yourself out, and when you saw the need for more funds to buy inventory, you should have redeemed or have sold your tax-exempt securities, and then you would not have needed the loan. I'm not going to say you're going to lose on that issue, but I think they're going to raise it. That was my job for years, anticipating and then finding out that I was correct, that they're going to challenge something. But what about this situation? You have a portfolio of tax-exempt securities. You've done careful budgeting. But you have an uninsured fire that damages one of your retail outlets. So you have to take out a loan in order to refurbish and restore the property. There, I think you have a stronger argument, where you wouldn't have to liquidate your tax-exempt securities because you could not have anticipated the uninsured fire. So you can see in real life, it's those kind of situations. On the exam, it's the more obvious one, interest on the loan to buy tax-exempt securities. But in real life, it's a mixed bag, and I think the one case is stronger than the other one. Job hunting. Oh, this is, what are typical job hunting expenses we might have?
Internet?
Go ahead.
Internet costs?
Yes, could be, sure.
Printing for resumes?
Printing for resumes. There's companies that will review your resume for a fee. By the way, we have career services here at Keller, where they may do that for nothing. Plus, there's some kind of career space in the student portal. In the loop, it's Bree. They hired Fee Mister, who handles all that. And there's a lot of things that are there. They give sample interviewing questions that they might ask you. And this is all free, but a lot of times if you don't have, like the school, you have to pay for these services. Well, anything else of that nature. Now, one thing though, these job hunting expenses are deductible as miscellaneous itemized deductions. They would be miscellaneous itemized deductions. That means subject in the aggregate to a 2% of AGI reduction. Subject in the aggregate to a 2% of AGI reduction. Let's stop a second. We're not done yet though with this. Everyone knows what it means. You take all your miscellaneous itemized deductions except for gambling losses, and you add them up. And then you have to subtract from that total 2% of AGI. That's thanks to the 86 Act. That affects me personally. And then that's the amount you can deduct. But the job hunting must be for an occupation in which you have already been employed. It must be an occupation in which you have already been employed. What do a lot of people do when they get older, especially less educated people? They change their profession. It might be that in the old days you were a blacksmith. Now the only blacksmiths are at racetracks or something. There's not the need. You got to find a new job. And a lot of people who are in those high-paying, factory jobs, their jobs are gone. With the offshoring of everything here, or the automation, the robots at the auto assembly plant. So you have to be in the same profession. It's kind of like we mentioned last week when we talked about educational expenses are not deductible if they qualify you for a new trade or business. The same basic idea. Uniforms. What's the rules on uniforms? Deja knows, but she's giving everyone a chance. Well, she already heard it. She's dedicated. She's coming. She came Tuesday. She's coming today too. You guys could have come Tuesday if you wanted to. Room 704. Well, the uniform it must be worn. The uniform must. Yeah.
Right?
The first factor is the uniform must be worn as a condition of employment. Like in the military, I was in the Army. You have to, I mean, they say if the uniform of the day is Class A, you have to have it on. You had to wear the uniform.
I was in JROTC, we had to wear uniform.
You had to wear a uniform,
Different
exactly.
days
Yeah,
of the
on the
week.
days you had drills or something, sure. If you're usually like if you're delivering Coke or something, that big truck, they have a uniform on with the emblem. And the uniform and also, this is for maintenance or the cost of acquiring the uniform is not suitable for normal street wear. The uniform is not suitable for normal street wear. I'd like someone to research some cases in this area because, I mean, in theory, someone pointed out on Tuesday, well, you see these nurses and these people who work in hospitals wearing their scrubs on the street. I always remember once in the New York Times, this is back in more innocent times, like the 80s, they showed a gentleman who was naked walking down the street in Manhattan at lunch. And it showed people around him weren't even looking. They were concerned with their own activities. No one even paid any attention. So if that was his goal, like the old streakers of the 70s, it didn't work. I'm sure a police officer was interested, however. So again here, what's suitable? And it's interesting to note here, I was watching a movie last night before I went to bed. Bill having served in the military during Vietnam. It was that Mel Gibson movie, We Were Soldiers Once and Young. Well, I didn't have to go to Vietnam, but most of my friends did. And when they came back, and even once I was downtown, I was on active duty, and I had to go to the federal courthouse. I remember I had to testify in a case for representing the Army, and people shouting stuff out, negative things out at me. I was with two other officers, and we're walking down the Wells Street, and people are yelling out, Achtung, Sieg Heil, and stuff like that. It's not like now when the soldiers come back, from Iraq and Afghanistan, and there's parades and so forth, which are appropriate. But when we come back from Vietnam, we didn't get that treatment. In fact, I was reading in a commentary the other day, a lady was an Army nurse in Vietnam, and she was advised when she came stateside, immediately change out of the uniform and look like a civilian. So she said she went to LAX, and she took her uniform off and threw it in the garbage and put on a dress or something she had with her. So was the uniform suitable for street wear? Well, it gave you a lot of insults and so forth, which was most unfortunate. So someone look at that. There's the cases. There was some case where some lady wore designer Paris gowns or something, and the lower court said that was acceptable because she wouldn't wear that on the street. And then I thought that was reversed on appeal. So we can get a few people looking at uniforms. And if you do have a deduction for uniforms, guess what? It's part of the miscellaneous itemized deductions, like the job hunting, like union dues, that in the aggregate must be reduced by 2% of AGI. The next item is not on the exams, but I put it down there and it's in the online discussion. You should look at it just for your own knowledge. And that's vacation homes. We've had some posts on that. Remember that 14-day rule? When I was a kid, we lived in that Austin neighborhood, West Garfield Park. And I remember for a few years, my grandparents would come by and we would drive up to, there was a guy in our neighborhood who owned a cottage in Silver Lake, Wisconsin. So we would rent it from him for 2 weeks. He said that covered his real estate taxes, and then the rest of the time he used it only for his family. So you might have something like that in one of your families. There might be a cabin in northern Minnesota or Michigan or Wisconsin or something where you go. I'm not testing that, but you look that up again, and we've had some posts already. We may have sufficient posts in there, but that's why I included the online discussion. Fines, penalties, and kickbacks. Interesting, they try and trick you on the final exam. For example, they'll ask which of the following would be deductible. One choice might be a fine you incurred when speeding in your personal vehicle. And of course you say not deductible. But then they have down a fine that you incur when you're speeding in the company truck on company business. What's the answer there? Not deductible still. Bill, it's business related. Yes, but what is it? It's a fine. It's a penalty. So it's still not deductible. But see how they're trying to trick you? Now, kickbacks. Do we know anything about kickbacks in the Chicago area?
Not at all.
You want to get a zoning adjustment in the city through city council? You know what you need to do. But generally, kickbacks are not deductible. Now, I put in some cases, Raymond Bertolini Trucking and Car Run Asphalt Paving, which are cases that are out of the Sixth Circuit, if I recall, that have contrary results. Bertolini Trucking is the only case I've ever found where a kickback was deductible because it was deemed to be an ordinary and necessary business expense. But someone can find that case and find Car Run Asphalt Paving. It related to the construction of a shopping mall in Akron, Ohio, the Rolling Acres Mall. I would say the general rule is they're not deductible. I think the exception for Bertolini was a reward. The gentleman who solicited the bribe was surprised by Bertolini Trucking when they issued him at the end of the year a 1099 non-employee compensation, which he was not expecting. So take a look at that area. Moving expenses. This one is on exam 2. Moving expenses. Okay, I'm going to put down 2 categories. The first one is no longer deductible, and the other one will be still deductible. Again, we've had excellent research from both classes that, have a lot of the same information in them. All right, first of all, under no longer deductible, the cost of meals, put that in italics, the cost of meals in transit to the new location. The cost of meals in transit to the new location. For example, one of my favorite cities, San Diego. I'd love to be there, live there. Nice temperature, high cost of living though, and not limited job opportunities. In fact, if I were in San Diego tonight and didn't have class, where would I be?
I'll take it.
Probably at Petco Park because the Cubs are playing there.
Ew, you're a Cubs fan?
Well, when I was married, whenever we went to a city that had a professional team, even if it wasn't a team we were interested in, we'd actually go to the ballpark. You know, what the heck? But at one time, I remember we went to Pittsburgh for a weekend series where we went to multiple Cub games. But if you say, have I been to Wrigley Field more or the White Sox Park, the Cell, I've been to the Cell more because it's easier to get tickets. But anyway, so let's say I decide I'm going to move to San Diego and I'm going to drive there and I'm going to be stopping at McDonald's on the way. I can't deduct the cost of the meals in transit. Secondly, under no longer deductible, the cost of temporary house hunting trips. The cost of temporary house hunting trips. This is interesting because you're going to a new location, a new area, and you want to buy a house. You want to go out there and check things out in advance unless you're familiar with the area. I heard of a story here from some friends. They had people who moved to the Naperville, Aurora area. They bought a home. They thought it was in the school district for, it was either Neuqua Valley or Naperville Central. Unfortunately, they missed it by 1 block. They're in the East Aurora.
Oh.
Go Tomcats. They're in that district. And nothing against East Aurora High School, but it's not the caliber of the other two. So temporary house hunting trips, it's nice to go there and visit and so forth, but you can't deduct that. And thirdly, the cost of storing your household effects for an extended period of time. The cost of storing your household effects for an extended period of time at the new location. Well, you won't let me do house hunting trips. All right, fine. I'm going to ship my stuff out, I'm going to put it into a storage facility, and I'll stay at an extended suites hotel or some type of apartment house where I can get a short lease. They're restricting that as